See, I wrote an algorithm earlier specifically for value blue chips. It wouldn't work for growth stocks, but the main thing to look at was the EPS, earnings per share, and the PE ratio was a main part of that equation. But growth stocks had a harder time, or excuse me, growth stocks did way better than value stocks. And value stocks, if you think about it, if there was a downfall in the market, they have they're a little bit more resilient than the growth stocks, right? Growth stocks are also very susceptible, I want to say, to interest rates, right? Because all the money goes back into growth, and if you're borrowing cheaper money, you can have your company grow faster. That's the general thought of it.
Overvalued, and he's got a shopping list of value plays for 2025. Joining us now is Ariel Investments Vice Chairman Charlie Babrinskoy. Charlie, Happy New Year. Great to have you back on. Let's start right there. And the fact that, once again, 2024 was a strong year for growth. We certainly saw it in the number of companies that swelled into the trillion-dollar club, if you will. How does that position us for value? Where do you see value now?
So like any good value investor, I'm not going to say I know what's going to happen in the short term, but what we do know from history is that the best predictor of future performance over the 5-7 year time frame is forward multiples. That when markets are trading at reasonable multiples, you tend to get reasonable performance over the next 5 to 7 years. When things are at high multiples, you tend to get pressured returns. And that would indicate that value is set up pretty well. Large cap value set up pretty well. Large cap growth not set up well. So large cap growth trading at big premiums to their historic run rates. They are very popular right now. Value is very much out of favor. That makes us feel good, but I'm going to acknowledge I have said this for the last couple of years, and growth has continued to outperform.
So where specifically do you see?
So growth continues to outperform, and if the Fed cuts more, which they said they're going to do, growth will continue to outperform. I think it's It's like 10% increase for every 1% decrease that for the Federal Reserve for the discount rate. But what he's saying here is that if everybody's already run to growth, then value still has a little bit of running room. So that's basically what he said.
Value, and value that is not value traps. And I ask that knowing also that we've had a pretty strong run in the dollar, and perhaps that puts small and mid-cap stocks in bigger focus.
So there are a couple of sectors that haven't kept up, where total production and capacity has been below historic averages. Number one is housing. America is not building the houses that it has historically or that we need. And a lot of that has been regulatory. A lot of that has been interest rates. And so I think both.
A lot of it's been. So the regulatory part hit was since, 2010 till 2020. That's what created the shortage of housing, and that was done by the Dodd-Frank Act to prevent another 2008 market crash. And that has been compounded by the interest rates. So all this, there's a huge shortage of housing, and if you know, supply and demand. If there's a shortage, then the price of housing goes up. But here's the problem: if the price of housing goes up, it becomes less affordable, which means that less people are buying it, which means the producers are producing less. So it's kind of this downward spiral, if you will, in housing. And housing is closely tied to the business cycle, right? So, I've said this before. If they were to reform the Dodd-Frank Act and our horrible frickin' media wouldn't just start attacking. If we actually did something good for our country and it wasn't politicized, that would be great. But I think that the answer that more people are looking for is lowering the interest rates, the discount rate by the Fed, and hopefully the 10-year will follow, right? But we shall see. The 10-year is directly tied into mortgage rates.
Both of those things are going to get better this year. We've got housing names trading at very attractive prices when I think we're going to get an increase in both new construction and sale of existing homes. So that would be number one. We love names like Mohawk and Residio, the thermostat company. The second is going to be regional banking. The regulatory environment has been terrible for mergers. An inverted yield curve is terrible for regional banks. Regional banks tend to borrow short and lend long, and so an inverted yield curve is just brutal. That's going to get better. And we're going to see, for the first time, some takeovers, we think, in regional banking. We love Bank of Oklahoma. Is my favorite name in that space, and Northern Trust would probably be next. And then the other out-of-favor space is consumer staples, some names like Smuckers that make Hostess and Twinkie products that right now people are worried about what Kennedy might do to those companies, and
I'd be worried what Kennedy would do to him too. But the fact that he said consumer staples is also pretty good, especially when everything is at a high PE ratio. Those consumer staple products have a lower beta, but again, I would stay away from the ones that have more political risk, like the ones that Kennedy is probably eyeballing. But there's plenty of consumer staples that would, if you're not looking for growth and you're looking for something more resilient, if there's a crash, you could take a look into those. By the way, I'm a professional investment advisor. This is not investment advice. This is just for education. And the more you watch this channel, the more you're going to kind of understand this language, and you'll have a better idea, and you'll be able to form strategies that kind of work for you. Because listen, if you go on YouTube for financial advice, I would say just run. Don't even. If you don't know what to look for, just run. You'd be better off watching shows like CNBC like this. But the problem is you don't have the vocabulary. You don't understand how these systems work. So listen, you should subscribe to my channel. But at the same time, if you're looking to invest like today or tomorrow and don't know where to do it, seek a professional advisor, and they'll be able to help you out.
We think that's going to be temporary, and people are going to keep eating their Twinkies and Ho-Hos.
Charlie, have you explored the possibility that there's a structural shift in the U.S. economy, maybe global economy, where more value is accruing to digital players and more of the digital plays are being made by larger companies, and the effect of that on value?
That's the best argument for why growth is outperforming, that this time is different. That this time there's something fundamental going on in the market that's going to make the higher valuations for growth stocks work out in the end. And we're always skeptical of that. People obviously said that in the 70s when digital computers and big mainframes were coming in and the Nifty 50 stocks got so expensive. We don't think that fundamentally is going to change, and that there are a lot of smaller companies that are benefiting from.
It's always a slow change, right?
In the economy, but you're absolutely right, and I don't want to downplay this. I've said this for the last couple of years, and these digital AI stocks have continued to do well, so that it's very hard to time this.
If we are in sort of a new digital robber baron era, where scale and ability to control, and if not monopoly power, just outsized power matters particularly, does that affect how long it takes value stocks to come back stronger?
I think value stocks can do okay in that environment with the productivity improvements that come from digital and AI. And of course, I'm going to point you to my favorite digital stock, which is Oracle, still trading at a sub 20 PE, and the dominant player in data software, which is going to do very well in an AI.
PE stands for PE ratio. It's basically a multiple of how much it earns versus the price in the market is. And if you look at what the average, okay, so this is how you do it, right? You look at what the average PE ratio for benchmark companies in that sector are versus what the one you're looking at. And if it has a lower PE ratio, you can consider that a value buy.
AI world. But you're absolutely right. Small companies and value stocks are not going to be the dominant players in AI, but they can be a big beneficiary. We have names in banking that are going to take costs out. We have names like FAF, which are going to take costs out. So smaller companies can be big beneficiaries while the large companies fight it out amongst themselves.